Today we're going to be talking the sexy and exciting topic of insurance. Now don't switch this off just because we're going to be talking about insurance, because we've got Johny Winstone in to tell us all of the things we want to know to learn more about this exciting space, mate. A man that I believe has been in the industry for over a decade now.
Coming up to it, yeah.
Yeah, what drew you to the insurance industry originally?
Well, mate, it was actually with a bit of family encouragement. So my wife's father has been in the industry for close to 40 years now. His father, his grandfather were also in the space.
Wow.
And I was at a bit of a crossroads about 10 years ago, and I was looking at sort of two fields to get into. One was actually to look at going into supermarkets, and then the other was going into insurance. And so I went out and ghosted him for a couple of days, and he was able to show me his process, what he does, how he interacts with people, and it just started to resonate with me. And the thing that I was looking for out of my career was to be able to provide value to people on an ongoing basis. And I truly see that our personal insurance offering is a way that we can achieve that. Great way of meeting people, and, you know, an amazing way to build a business and lifestyle off the back of it. Yeah,
nice. So fast forward to today then, 10 years of doing this. How many clients have you got? You're a very busy man.
Yeah, look, each day's pretty hectic, but we wouldn't change anything about that. So we're managing a client base of about 6,000 people now. Yeah. So some of that's come through acquisition, and then a lot have come through my own network, individual clients that I've brought on, but always looking to grow into the future. And now I'm getting a big kick out of seeing other advisors join me on the journey and seeing them start to build their client bases. So each day it grows and gets more exciting.
What's changed from 10 years ago in the insurance space to now? Like, I'd imagine heaps has, but what are the sort of main things that you've seen in that time?
In the industry?
Yeah.
Look, I think we're starting to see this real influx of robo-advice come in, which is online provided advice where clients are going in, signing up to policies online. Look, I think it's great for exposure in the industry, but I don't necessarily think that clients are getting a true understanding of what's available and how they should structure their own personal insurance. We're seeing a lot of these clients that we happen to stumble across might only have a singular benefit in place, but they think that it caters to all of their risk needs, and that's not the case. So through education, we bring them up to speed, sort of show them what's available, and go through that process and put them in a better position.
So through some of the robo-advice, etc., they're potentially signing up for things that they don't actually understand or think they've got cover that they may not actually have?
Correct. And I think we're pretty conditioned, we're getting better in New Zealand anyway, of having some exposure to life insurance, but people are taking out a life insurance policy and thinking that's all they need, but they're not then going the step further to think about major illnesses and losing their income if they were to be out of work for a period of time. So without that education piece, they're doing what they feel is the right thing to do, but they're sort of missing a piece to the puzzle.
Well, any insights, mate, to stick to your craft for a decade? Like, a lot of people struggle these days to do 1, 2, even 3 years would be like a long time to stay somewhere.
Sure.
But I'd imagine that from once you get through those first couple of years, then you're into your rhythm, and then it's probably the same thing just about every day, every week, every month, every year. And would I be right?
Well, yes and no. I enjoy a lot of things about what I do for work, and fundamentally the big thing is people, right? I get a lot of value out of meeting people, meet some really inspiring characters along the way, which I take a lot from. Probably more recently, the challenge and the opportunity is sat in seeing the business grow and the involvement of now managing a team and all that comes with that. But yeah, each day seems to be different, but working with those clients, building those relationships, and now sort of years into it, starting to support them as claims are starting to arise for various health conditions or minor events, and just being there for them and actually being a voice that they can consult with, that they might not be able to with some of their own family even. They might not be able to get all of their advice from their doctor. So we do turn into a bit of a counsellor, and we really respect and value that position that we hold with clients, particularly at that point in their lives.
Because I imagine a lot of people probably just look at insurance or the industry and think, oh, you're just selling people insurance. But that's just literally the start, right? Then there's ongoing advice, making sure it's fit for purpose, and also helping them if they need to actually use it.
Look, I personally run quite a pragmatic approach to people's levels of cover that need to go into place. I think a lot of people can quite often build in nice to haves in the values that are getting created, but in turn that's going to increase the premiums. Yep. So by running a more sort of staged approach to people's insurance, We put in place what's required now with a 12 to 24 month lens on it, but we stay in regular communication and start updating as their life dictates it. And that might be increases depending if their family's growing, if they're taking on more debt, but it might equally be decreases as things are starting to improve in value in their background, whether it's KiwiSaver balances, the property values, mortgages getting reduced, kids are now getting older. There are always a lot of variables that are constantly shifting, and we don't want to fall into a trap of going, hey, look, we're thinking about having kids in 3 years' time. Let's consider that in part of the life insurance conversation now, because you take out more cover than that's what's required. And it might not be 3 years, it might be 5 years. So why pay the additional premium throughout that period of time? Just build a relationship with your advisor and sort of actually, be open to having that review, because it's not always about us coming out to sell you more insurance. That's not the aim of the game. We just want to make sure it's reflecting your position on an ongoing basis.
Yeah, nice, and that it's actually sustainable. Because I guess the worst thing is that people then get rid of their insurance because they don't, feel like they need it, and then they've got no cover.
Yeah, or people just don't engage with us for reviews, not so much with our clients, and then they start getting a bit disgruntled that they've just got this outgoing and they don't understand what it's for.
Yeah.
And so we find through the review process, if you keep the conversation refreshed, people understand it, they get it, they see the value in it, and they're quite happy investing that premium on a monthly basis to know that they have that good solid plan B.
So when you got involved in the industry in year one, did you see yourself doing a decade and carrying on from there?
Yeah, I did. I absolutely saw it as my career.
Nice.
And I was exceptionally fortunate to have my father-in-law's guidance on the way through, and I'm very grateful for him early on in particular.
Yeah.
In fact, he said he didn't want me early on, so he kicked me to one of the corporate insurers, which was the best thing I could have done at the time to get their training, get an understanding of the insurance world. And as I say to people, I went and joined him after a year and got the real world training of how it actually works, and became an independent advisor, so we work with all insurance companies. But yeah, it was always going to be the career. There were always grand plans of working in his business with an aim to take it over. That by default has actually started to change over the years. My business has got bigger. Still a conversation that's on the table, but look, there's always something to work through.
Yeah, nice one. Well, insurance is a very wide topic, right? So let's just narrow it down a little bit in terms of the types of insurance that you're mostly focusing on. And I had a quick look that apparently the most popular types of insurance in New Zealand, I'm keen to know if ChatGPT's right on this, mate. Health, life and income protection, if we stay away from general and fire and stuff like that, right? So would that be, are those like the key three these days that people are looking at?
Absolutely, yeah. So those are the fundamentals to insurance, and inside that there's a few different benefit subsets that you can consider. But certainly my focus sits in the space of looking after individuals opposed to assets. So those are certainly the benefits that we offer to all of our clients. But probably the big one that's missing from there that I'd be most passionate about is something called trauma insurance, which is really focused as a lump sum payment that's made at the diagnosis time for major health conditions, whether it be cancers, heart attacks and strokes. But to me, that is the biggest life insurance related benefit that can really protect somebody's overall financial position. Getting that cancer diagnosis can be heartbreaking. It can be financially very unsettling for people. But having this payment come through at that point in your life can just take a lot of pressure off. It allows you to focus on the recovery without having to sell assets, come out the other side and still be in a sound financial position for the rest of your life and also retirement.
So so trauma, is it a type of life insurance, did you say?
Yeah, so I broadly refer to everything as life insurance. However, inside life insurance, there are other lump sum payments, whether it's the trauma benefit, another one called total and permanent disability cover, which is centered around loss of the use of limbs, but more commonly now we actually see it getting paid out around mental health conditions, which is a growing area of concern in New Zealand. And then we have the sort of income protection related benefits, whether it's purely to replace income or if it's centered around making sure the mortgage can be serviced if you're out of work.
Getting in the KiwiSaver fund that suits you and your situation is key to making sure you're maximising your investment. Generate are an award-winning KiwiSaver provider with a track record of long-term performance, and they can help you do exactly this. Their advisors can meet with you to talk about all your options when it comes to KiwiSaver to help you decide what's best for you. Too many people never get KiwiSaver advice, but not you. Go to generatekiwisaver.co.nz/change to book a no obligation chat with a Generate advisor. A copy of the product disclosure statement is available at generatekiwisaver.co.nz. The issuer of the scheme is Generate Investment Management Limited, and of course, past performance does not guarantee future returns. So your trauma cover could, like you said before, it could be cancer, heart attack, stroke. So you have one of those events in your life, and basically that then potentially triggers the payment of that, and you can use that to support your income or the cost of how your life now looks.
Well, it's more about meeting sort of increased living expenses as a direct result of getting that news.
Yeah.
So quite often what I've seen with some of my clients is that they may be out of work, and also their income's been reduced or disappeared completely, but they in turn then need their partner to stop work to now care for them or be able to look after the children on a full-time basis.
Yeah.
So we're actually allowing for both parents in some cases to be out of work and be able to financially manage that. But it's more about meeting the short-term unexpected expenses opposed to it being a long-term strategy for replacing lost income. And that's certainly where the value starts sitting in income protection and mortgage repayment benefits.
Okay. So then life insurance, this one seems a little bit simpler, is built around you pass away or you may pass away. Is that right as well? Or that's different again?
Correct. So I think that's a big misconception
Yeah.
is that it's just a benefit that pays out if you have passed away. The reality is that it can also pay out if you have a terminal illness where there's less than a year to live. I've had quite a few clients who have unfortunately been in this position, and it's been very interesting for me to be part of that journey with them. But in our conversations, the life insurance value is normally equated by, their mortgage level, what levels of income we need to replace if they have passed away for their family. But when people have had a terminal diagnosis, I've had clients that have put their family onto a plane, they've gone and had the family holidays while they still had the ability to do it.
Yeah.
Had other clients who've gone out and bought a motorhome because that was always part of their retirement dream, and they still wanted to be able to do that together before they had to come back and deal with the reality of their situation. So in our conversations, we have to centre it around tangible items. But when people find themselves in that situation, all bets are off and other things can be exercised.
Yeah. So basically, let's say someone, how do you actually prove that? So you get a terminal diagnosis from a doctor, I assume, and then you go to your insurer or your advisor and then say, hey, unfortunately, this is my situation. Have I triggered my insurance policy? And they just wire the cash over. Is that kind of practical?
In effect, that's how it works. So two specialists in that particular field would need to sign off that it was a terminal diagnosis with that timeline. But from there, it's actually quite a straightforward process. And with life insurance claims, with the paperwork being available, claims are often paid within inside a week.
Wow.
So it does give very quick access to those funds. And those funds might not go into the family holidays or the camp events like some of my clients, but they might also go into additional medical treatment that might be available overseas, and it's not funded through our public health system or even the New Zealand-based medical insurance policies.
Yeah.
But because they've got those funds available to them, they might be able to make different decisions that weren't previously available to them.
So insurance is basically de-risking a potential outcome, right?
Correct.
No matter which way we look at it, whether it's a fire or death, etc.
Correct. Yeah. Until you're in a position where you can write a check out to cover the financial exposure that sits in your life, that's where there's value in having that insurance in place. And as I say, as your position evolves over time and other assets grow in value, your need for insurance is actually going to taper off. So we need to map that out on our journey through our review conversations.
From your experience in the industry, mate, when do people normally first get introduced to insurance in New Zealand? Is it around purchase of the first property?
Yeah, bang on. So it's either triggered by getting married, which is probably less common as the driver to take out insurance, but then certainly having children and then taking on debt where their financial exposure is starting to increase. That's where we need to cover that financial risk through insurance.
And so does that look like, okay, I've now got debt. If I was to lose my income or life, etc., I want the comfort of knowing I've de-risked this situation with a financial side on the other side of it, where that could clear some of the mortgage or ensure that the mortgage can still be paid so we don't lose the property?
Correct, yeah. So it's just taking that practical approach, and if it's a young couple buying a property and it's 50-50, it might not necessarily be that we're gearing your life insurance up to cover all of the debt, because you might not have any dependents yet. You both might be making good levels of income. So it's more about just reducing your share so that no financial burden's passed on to your partner. Equally, the same logic applies to income replacement. We don't always need to cover all of your income. The levels are really going to be dictated by your current commitments and forecasting what those might increase over time, and making sure that financially we have a plan in place to manage that.
What about people being made redundant at the moment and losing their jobs and stuff? Are they covered with some of these policies, or does income protection not sort of cover that space?
Yeah, it's certainly a pretty topical conversation at the moment.
I bet you're getting some phone calls.
Yeah, we're certainly seeing a rise in requests to take out redundancy cover. In short, it is still available in New Zealand, but post-COVID, a lot of the insurers pulled out of that space. So we're down to two options. Can't be taken out as a standalone benefit, so it needs to be taken out in conjunction with an income protection or a mortgage repayment benefit. But yes, they're still certainly available and certainly become in hot demand. Personally, I feel individuals really need to look at their situation. They need to look at their employment contracts, work through it with their advisor to see if it's actually going to be the right fit for them, because they might actually be getting enough of a payout through their redundancy clauses in their contracts to actually outweigh what the benefit is in that redundancy product. And I always say to people, with redundancy, the likelihood is that you've actually still got your health and your ability to work. So you might not go necessarily straight back into your dream job and dream levels of income, but you can still go out and work and get by and work your way back to those positions. I would always be more focused on when you've lost the ability to work, when that big accidents happen, when the major health conditions come along and you're out of work, it's out of your control with an unknown timeline. And I tend to put more focus on that side of the conversation because of the long-term risk associated to it.
And with the average age increasing for the purchase of a first home, I think it's gone from like 25 to 37 or something. Have you noticed that your customer age has increased naturally because then people aren't looking at insurance as early?
We probably haven't seen so much of that average age shift in our world. Like, as you know, I work with some great mortgage brokers. One of them sits on the podcast on a regular basis, and typically we're still seeing those clients be in their late 20s and early 30s. And I know that that's not the case based on the averages, but certainly the clients we're seeing and engaging with are typically in that late 20, early 30 age band. And then it's about building a relationship with them that we can look after them for the future and take care of them for their future insurance needs as well.
And is there, is there something we need to be thinking about when we aren't necessarily buying a property that we need to be thinking about insurance earlier? Like, is there a case for younger people thinking about insurance in their early 20s?
Sure. I mean, in effect, as soon as you start generating income, that becomes your greatest asset long term, right? So even if we look at basic maths for a 25-year-old who happened to be on 100,000, which I know is not always the case, but it makes the maths easier. Even without inflation and without any pay increases, over a 30-year time period to retirement, 40-year time period, sorry, might need to edit that part. That's effectively a $4 million asset to them that they might lose out on generating because of one of these unexpected health conditions arising. So my view is that the conversation should start early. We don't need to over-insure you early on, but we do need to start managing that risk as soon as you start generating income. Because most people who are working, to the most part, will be already renting properties. They might have some car finance. They might be making, they might have committed themselves to some financial commitments and debt. So the question does become, even at a young age, how would you support those expenses that aren't going to disappear because you're not working? And that's where the insurance piece comes back into it.
And on that, is it cheaper when you're younger because you're then less likely to die, probably statistically? Because this is how insurance is calculated, right?
Totally. Yeah. So look, the premiums are very affordable for younger clients to put good levels of cover in place. As you get older and that risk profile changes, then that is reflected in the premium structure. But there are a couple of approaches to this. So one, if I go back to the review, it's about managing the levels of cover that are in place, because we don't want to have you overinsured and overpaying for premiums. And then the second option is we can take quite a long-term approach as to how we want to structure the premiums on the policy. And a lot of people just think that there's only one, and that's what we refer to as a rate for age premium. So that's going to be each year the premiums are calculated based on your age, and as you get older, which we can't control, that's going to start to in turn increase the premiums. Or we can take more of a long-term strategy and use something called a level premium, which is kind of like a fixed mortgage rate, where we fix in a fixed monthly premium for a defined amount of cover over a fixed term. And typically that's to age 70 or 80. And we know that we're basically going to lock that level of cover in at a known quantity each month until you turn 70 years old.
Yeah.
So while it might work out to be more expensive short term, the savings over that term of the policy are substantial. It's just about making sure that it's going to be financially affordable for each client, which is a big part to our conversation, and that it fits in with what their long-term objectives are in regards to their insurance position.
Then a bit of a tangent. So I'm fairly sure every time I go and see my old man, he tells me how his life insurance is getting more expensive because he's getting older, and he's like, you can buy it off me. So like that's still a thing. People still do that.
Yeah, look, it's a pretty challenging conversation for people to have, and it's kind of taking a bet on mum and dad that at some point in time that they're going to pass away, which is a sad reality, but we are seeing that more commonly happen, where children will start to pay for their parents' life insurance policies because they are going to be the beneficiary. So we don't see it a lot, but it certainly is happening.
And so in that position, do they, like, would I just start paying his insurance on his behalf, and I get something in writing to say, should he die, that money, those funds don't go to the estate, they go directly to, I become the policy holder?
Sure. So there's a couple of different ways that we can set that up. So either we can nominate a specified beneficiary, or you might even become a policy owner on your dad's life insurance policy, which means that you're paying the premium, but in turn, if he passes away, you can speak to the insurance company and those funds will be paid directly out to you.
Yeah, wow. Because I guess then the insurer's not going to, they'd rather probably it be paid, right? But if he cancels that, then basically that's like it's gone.
Yeah, so in New Zealand, we only have something called term life insurance, which is effectively a yearly renewable policy, and it's a fixed amount of cover for set amounts of premium. But at the end of the policy, or when you choose to cancel it or make significant adjustments to it, that becomes the end of it. We used to have these benefits called whole of life or endowment policies, where they were a combination of life insurance and also investments. But ultimately, we didn't have the scale in our population to make them work. Countries like China and India, they've proven to be unbelievably successful because they can just get the people into it and get a bigger pool of funds working for the policyholders.
Yeah. Interesting. All right, maybe I have to have a serious conversation with my dad. He might even be watching. I'm not sure if he's joking or not, but I wasn't even sure if it's still actually doable. But
yeah, better watch out, Dad.
yeah, I have to go and see what it costs them. Hey, so what's the split then between the types of people that you're dealing with in terms of the type of insurance that they are getting support from you to put in place?
In terms of the age demographic or the profile?
Even the type. So, because I know you probably do some in the business space as well, right, which we can get to, but is it predominantly like life, income protection, those two spots, or even first home buyers, etc.?
Yeah, so I think particularly for new clients to insurance, it's really important to discuss all benefits, and some might not be relevant to their particular position, but that can evolve over time, and at least they've got an understanding of how those might fit in. Certainly with my clients, they would always have life and trauma insurance as an absolute minimum foundation plan. Medical insurance is a good cornerstone to have in that because some of the medical costs in New Zealand are starting to skyrocket.
Yeah.
And I think that problem is going to compound in the years to come. But typically, as my clients are typically first home buyers or they're going through a refinance process, they will always have mortgage repayment or income protection in place. And it's case by case depending on what they do for work and how their finances are structured as to what's actually going to be appropriate for them.
Well, on that, there's a lot of chat at the moment about the cost of insurance increasing, and I think people are feeling it. What's driving that cost of insurance increase?
Well, in the life insurance space, over the last couple of years, one of our big hurdles has been the inflation rates have been so high. So the policies are typically increasing as you get a year older, but they're also increasing with inflation. So that inflation rate is impacting premiums, and it's also increasing the sum insured value of the policies. So that's to make sure that a policy that was taken out 20 years ago is actually staying relative to the cost of a dollar into the future. So that's certainly been a big stumbling block for people over the last couple of years. But once again, in that review process, you can actually discuss with your advisor declining that inflation readjustment, which can help manage some of that premium change on a year-to-year basis. And you don't need to decline it forever. You might do it this year, you might skip it for a couple of years and then decline it again. But really, it depends on what your situation is. For most people, though, that have got maybe slightly older kids and their debt's reducing and their financial position's getting stronger, they might not have a need for that life insurance policy to keep increasing over time as well. So that's where we might permanently turn that inflation readjustment off.
I see. So that's basically saying, let's say like when I took out life insurance, it was 200 grand, but that was probably over 10 years ago. So I want that to be adjusting to become adjusted for inflation so that it's keeping up with that. So I'm then I'm actually insuring myself for 330,000, for instance.
Correct. So it's all
or
relative.
$1 million in New Zealand.
Yeah. And I think one of the other big components that we're seeing is that, particularly if we look in the medical insurance space, we're starting to see a huge increase in claims starting to flow through across all providers here. And, the reality is we're pretty fortunate in New Zealand with our public health system, and they're very well set up for acute related conditions, and I refer to things like heart attacks and strokes. But for non-life threatening conditions, whether it's hip replacements and events like that, it's all severity based and it's a waiting list, and there's just an unknown timeline to that. And people are starting to get frustrated with it, and the timelines are actually getting blown out. So we've seen more and more people take out private medical insurance, which in turn is putting more pressure on the private world. And in turn, some of those prices are starting to increase from those specialists, and surgical costs are increasing. So it's a compounding effect as the pressure gets put into the private sector. In turn, that's going to see the premiums start to increase.
I wonder if we could see a time where maybe people paying for their own types of insurance that are then taking the pressure off of the public health system could then be tax incentivized, so that becomes a tax deductible expense. I'm probably hoping for something that's never going to happen, but you know what I mean? Like, people are kind of insuring themselves to go, okay, well, I don't want to have to wait, so I want to be able to go private. And if they've got the means to, they can afford to, then they aren't going to use the public health system. So then they're both paying tax and then paying an insurance, so that they don't need to use it. I wonder.
Look, it's a great pipe dream, and we'd certainly support it in our world. We start to see elements of that creep in. Like for all self-employed people who are paying ACC levies, there are actually ways to adjust how much is paid to ACC, and with some of those savings, it can offset the costs of putting in far more comprehensive income protection, mortgage repayment benefits to cover the same risks that ACC would have. But you'll also have the benefit of covering health conditions, which there's not a lot of financial support for through the public sector. Yeah. So, look, it could happen. Certainly,
probably not.
Let's start another poll, get some signatures, and see how we go. But look, it would be great to see initiatives like that come through. But it's certainly nothing I'm familiar with at the moment. I don't think it's on the radar for the insurers to be driving it at this stage.
Yeah, but I guess what you're saying as well is that as more people have then thought, okay, I can pay for this insurance myself, then they're needing to use those claims, and then that's just putting more people into the private space as well, which is then driving up demand and therefore price too.
Yeah, so if we look at one of the health insurers that we work with, in July, their claims stats were up. They had 30% more claims than their previous month on record. Wow. So in turn, that's just a great signal that the private sector is getting more and more use. More and more claims are getting paid. So this particular provider had about 260,000 claims in the 23 financial year.
Sheesh. Yeah.
So it's massive.
Yeah.
And they're a good scale size insurer, but there are other bigger providers out there that are seeing far greater levels of claim volume flow through.
Beat the power game with PowerShop. If you want to get ahead with your money, you need to get ahead with your bills. back in the day, I used to get a little thrill when a power bill would arrive in the mail and show that I was in credit. The thrill of being ahead of your bills is a feeling money can't buy. PowerShop is in the business of delivering that feeling. They do things differently, giving you the insight and control over your bill to stay ahead. With PowerShop, you can see what you're using and purchase power packs, which are discounted packs of power, ahead of time. This enables you to plan ahead and pay for power when it suits you. All in all, being with PowerShop means you're informed and empowered to take control of your power bill. So, what are you waiting for? Take charge of your dollars, kilowatts, and cents by switching to PowerShop. As a bonus, you can choose between a $150 credit or free weekends when you sign up. To see how much you could save, visit powershop.co.nz and get a savings estimate simply by uploading a recent electricity bill. Talk to us about the mental health piece that you mentioned before in terms of people being able to claim for that. Like, how is that coming about?
Yeah, so look, it's a complicated one. But if we look at sort of short-term events where we might be able to work for things like burnout or isolated stress, that's when we start to lean on benefits like income protection and mortgage repayment, because it's recognising that you're out of work due to medical reasons, and we're going to make sure that there's continuing cash flow coming through in that particular situation. For very advanced conditions where you might permanently be taken out of the workplace, that's where the total and permanent disability benefit can come through and support you with a big lump sum payment to help support that transition and sort of support you longer term. The health insurers in the market are doing what they can. Personally, I feel like there's work to be done by the insurers in this space, but we are starting to see some positive movement from some in health insurance as a benefit, offering sort of $2,500 worth of psychiatric support. We're starting to see some of the bigger insurers in the marketplace really drive wellness programs as part of their insurance offering to sort of better support their clients, making sure they're staying active, doing their annual health checks, and ultimately just keeping better tabs on their overall well-being. So it's a slow moving tide that we've got to ride, but there is work to be done in that space.
So if people have genuine mental health issues and they know that they've got forms of insurance, they should probably be reaching out to their advisor and saying, hey.
Absolutely. Yeah. We always encourage our clients to contact us whether they think that there's a claimable event or not. And quite often there have been cases where I've had calls from people and they go, look, it's probably nothing, but this little event's popped up, and I go, well, send me through this information. There's a process that needs to be followed, but let's explore it. Insurance is there to be used, and we encourage our clients to use it because it's no real work for us to try and support our clients at that point in time. And I've got a couple of examples where I've had those conversations with clients, and they've one example was a client who had a grade 4 skin melanoma cut out of his neck, and it was a very minor procedure to have it removed. But because of the information that we sort of guided him to get, we went from going, let's just cover the cost of the medical procedure, to him actually having a full trauma insurance payment. Wow. And he didn't think that he was going to get anything from it. In fact, he didn't even think he could claim for the medical procedure. So sometimes you just don't know what you don't know. I've had instances where we've had reviews with clients, and we ask them how their health's been and what's been happening in their sort of world, and you'll speak to a husband and wife. I can think of one story quite clearly in my head where a good New Zealand bloke said, oh, nothing's wrong, and I'm still 10 foot tall and bulletproof even though I'm 50. And I remember his wife just booting him under the table and said, what are you talking about? You had prostate cancer last year. And I was like, why didn't you contact us? And they're like, oh, we didn't think it was serious enough. We didn't think we could claim. It's like, well, let's get some, backdated information. Let's run through the process. And sure enough, we had a trauma insurance payment made for him. Maybe a little bit late, but better late than never. And the timing worked out well for his daughter because he funded their wedding as a result of getting the payment. So, that was a good thing to be part of. But.
Yeah. And so is there any general rules for people that do have insurance to reach out to their advisors or their insurance companies to remind them, like, if that happens, I probably need to tell them?
So look, we certainly try and stay in regular communication with our clients, and we ask those questions as part of the annual review survey that gets sent out. But I would just encourage people to reach out to their advisors and just say, hey, look, this has happened. What are my options? And it might be that it might be too early on in the process, but we can give you some guidance on what might need to be captured to support a future claim and things to be aware of throughout that process.
Even heard broken bones potentially for some people with the type of cover they have.
Absolutely, yeah. So there can be isolated payments made to recognise broken bones and fractures. So, I think you have to be a bit careful with insurance that you can cover absolutely everything under the sun, and you can cover yourself up to the eyeballs, and I'm really honest with this, but you actually need to pare it back and go, this is plan B sort of stuff. We don't want to set it up so it's going to financially enrich you. We're just making sure that financially you're still going to be in a really good place, even if something unexpected arises. So as I said earlier, I always run a pragmatic approach to putting the levels of cover in place that I do for my clients, because I don't want to overcomplicate it and I don't want them paying too much.
And how often should people be reviewing this? Is it, as simple as annually, or are we trying to remind people, a bit like a will, if you're having kids or you're getting married or something happens, like major events, you want to be reaching out?
Yeah, look, it's certainly an annual basis at a minimum, I would encourage. Not enough, in my view, changes over a 6-month period of time to dictate having a review at that stage. And it might even be that clients just don't want to engage with us for a couple of years because they just don't feel enough has shifted. They've set up a brand new mortgage, they've paid down $20,000 of debt. They don't see there to be enough value in adjusting the levels of cover at that stage. But I do say to people as well as, it's an open line of communication, keep us in the loop. We want to hear about your promotions. We want to hear about kids coming onto the scene, we're excited for you, we want to be part of the journey, and let us sort of guide you on what that means on the insurance side of things. Do we need to increase? Do we need to decrease? Because we don't want to always just keep putting more cover in place, and there's variables that'll happen for some people, and this certainly doesn't apply to everybody, but they might have received an unexpected inheritance, or there might have been some other sort of windfall that has come through. You probably don't need as much insurance anymore because you've been able to bolster your own personal position and your risk has been decreased.
I suppose you could have had an inheritance, for instance, and all of a sudden that completely changes your need for different types of insurance.
100%. Yeah. So everything's an evolving picture, and insurance isn't a static thing. It's certainly not a set and forget. Just engage with your advisors. I think for the most part, we're all pretty good sort of people, and we are just genuinely there to help you and guide you on something that you're probably not an expert in. And that's where the trap, I think, it falls in that robo-advice is people have gone on, think that they've got what they actually needed, but there are some shortfalls, and that's what we're there to guide them on.
Do you ever end up reviewing some of that robo-advice and then...
Sure.
Yeah.
We enjoy it. And it's probably quite similar to some of the old bank teller advice that was given in the insurance space. Ultimately they were bankers, they weren't insurance advisors. They just didn't understand it in a similar way to a specialist in that field, and quite often they've been sold lower quality benefits. So policies that might not cover a certain amount of conditions or the same level of conditions as some of the more, what I'd refer to as retail insurers might cover. The levels of cover can be completely out of kilter with what somebody actually wanted. So the robo-advice, the bank advice, it's always been a bit tricky, and we certainly enjoy reviewing those policies and putting people back on the path of what they actually need.
Nice. So if anyone's ever had robo-advice or basically over-the-counter banking advice in the insurance space, probably much like KiwiSaver as well, probably worth getting an advisor just to have a look at it. You don't even have to sign on, but 100%. Gee, wouldn't you rather know? Yeah.
Absolutely. And there's no cost to the client to engage with an advisor to get some initial advice. So we'll gladly run through the process. Ultimately, we are paid by the insurance company on the completion of a policy, so there's no additional cost to you. We're not going to send you out some hidden invoice that we're not disclosing. It's not the aim of the game.
I think in your space you even have to declare what you're potentially making on a policy.
Absolutely.
Right?
So we're completely transparent on the process, and we don't hide what's available to us, but it's a start of a good faith relationship with your advisor, with an insurance company. So why not be transparent right from the outset so everybody knows what the playing field is?
Yeah. Going back to what you were saying before, mate, about the cost of health increasing. So, because I think, Yeah, you'd be better to answer this. Do you think that a lot of New Zealanders don't actually realise how expensive an operation is or a medical procedure, even once you start layering in an anaesthetist,
Sure.
and just how expensive those people are,
Yeah.
and just a bit blasé of like, oh, well, she'll be right.
Yeah, I think there's probably a lot of misconception, and some of that might be driven by the fact that we do have a good public system and it has been so reliable for such a long time. But I think people's eyes are starting to open to what the true expenses associated to some of these procedures are now.
Yeah.
And we've got to look past just surgical expenses. There are other unrelated costs, particularly in that cancer space, around getting really good access to non-pharmac regulated medicines that can really support post-operative care, extend quality of life. But those drugs don't have any government subsidy at the moment. They're often privately funded. And those drugs can be wildly expensive in some cases. And,
Yeah.
I've had clients who have needed them. They've been as much as $10,000 a week. So
Wow.
just financially unmanageable for people who don't have these plans in place. And it's those people who are then having to sell the family home and sell the cars to try and fund treatment to actually prolong their life, which is horrible to see.
Yeah. I suppose it's like anything. We hope that it's not going to happen to us, but this is what this whole space is designed to do, is de-risk it if it does happen to us.
Yeah, absolutely. And, if we specifically refer to that trauma benefit, like we know that the average male actually claims at age 42 and the average female claims at 44. So some of these claim points aren't, just for our sort of parents' generation, the 50, 60-year-olds and older out there. It's happening to all age spectrums.
Yeah.
Last year I had a claim for a 3-year-old who was having some serious complications with respiratory issues and had to spend an extended period of time in intensive care. But, at nearly 40 now myself, we're starting to see our friends get impacted by it. I've had a friend of mine who's at 38 who had a stroke, and that potentially was going to take him out of work for the rest of his life. So
Wow.
Amazing to sort of see how these events are starting to creep into all age spans.
I suppose when we're in our early 20s, we're like, nah, don't need to worry about that stuff. Just like anything, don't need to worry about retirement. Nothing.
Yeah, life's good.
Yeah. And then it starts to creep up on you real quick.
Yeah, it does. And it becomes more real when you've got people who become financially reliant on you, whether it's a partner, whether it's children, whether it's the bank.
Yeah.
Life does get complicated, so we want to try and take some of that complication out of it and put in protection.
I was quite lucky. I had an employer and boss that sort of pointed me in the direction of learning about insurance at a younger age, and I've just always had it since my early 20s, and then got to a stage where I didn't have property, so I didn't even really need it, but I could then make the decision of, do I want to keep this? And it wasn't the sort of amount of money that I'm like, I just purely, can't afford this. But I'd imagine there's probably some people out there that go, well, I don't want to pay that, because then they, want to try and save it themselves or do that sort of thing.
And we're
Self-insure.
It's self-insuring is a thing, and I'm not opposed to it, but it's about having things in balance. But going back to your earlier point there, we're starting to see more and more corporates and bigger businesses start to implement these life insurance and medical insurance options for their staff. And for those businesses, it's a great retention tool for being able to keep really loyal staff to them. It attracts some new people into their businesses as well. And fundamentally, I think that starts educating younger people coming through, because we're ultimately an underinsured market. And
as a nation.
And my parents certainly didn't educate me on the value of life insurance. It's something that I learned as time went by, and I've obviously chosen it now as my career and ultimately where my passion lies. But the exposure to this is pretty minimal. Like, unless somebody's told you to go and take it out, and typically it was the bank when you got your first mortgage, from age 0 to that point, there's nobody else going, time to take out some life insurance or get income protection in place. So I think that the corporates and bigger businesses in the market do have a responsibility to their staff to be putting these benefits in place.
And is that something you do? So say an employer reaches out to you and says, hey, can you come and educate our team on some of these types of insurance? You go into businesses and give them a hand?
Yeah, absolutely. So quite often we'll actually try and run sort of financial programs that will work in with those businesses. we can talk about mortgages, and we get in brokers to discuss that. We get in KiwiSaver specialists to make sure that they're getting the best value out of long-term retirement savings. And then we bring in an insurance conversation. And whether that's going to be individual policies that are managed directly with new clients, or if it's with the business itself to put in layers to their offering to staff. Yeah, but it's absolutely a space that we operate in and really enjoy working in.
So if you say that we're underinsured as a nation, any data on like percentage of Kiwis that are covered versus other countries and stuff like that?
Yeah, so if we look at one of the biggest insurance companies in the market who currently sort of owns about 45% of market share, they've got about 800,000 policies in place.
Wow.
So we could sort of say that the other four main insurance companies would equate to sort of a similar value. So we could say there's around sort of 1.5 million at an estimate policies in the market at the moment.
Yeah, and is that across like health, life, income protection, etc.?
Correct.
Yeah. When you talk about health insurance, is that, that seems to be really popular at the moment around, I pay for XYZ insurance and I can get a massage and I can have my teeth covered as well once a year and whatnot. Is that health insurance?
Yeah, absolutely. Yeah. So, once again, having a pragmatic approach, particularly with medical insurance, there are a lot of add-ons that can typically go into those policies, and you do need to weigh up if it's the right add-on for you, or if we're mainly focusing the plan around costs that are going to be financially unmanageable.
Yeah.
But certainly, as we talked about before, there are these wellness programs coming out by insurers that are, really motivating people to stay active, be proactive about their health, get annual health checks. And if you're a part of those programs, they're amazing. They actually give you discounts on your insurance premiums. And the more active that you are and the more engaged that you are, the more discount you can actually add to your policy. And in turn, they'll start to give you vouchers, whether that's for movie tickets or groceries. So you can actually get your insurance policy, something that is a necessity, actually subsidising other parts of your life too. So it's a great program.
It's such an interesting space because there's so many moving parts, and just reminded a conversation that we've had previously where you said to me, you could increase your excess and then that's going to decrease your premium. So excess being if the insurance is to be claimed that you are having to let go of a lump sum of money, but then your insurance payments, the premium part is actually decreasing, right?
Yeah.
And I think it's probably, again, it's one of those things that you then have to think about, because you might get yourself to a point where you're financially sweet to cover a higher amount of excess, and then you don't need to be paying the same level of premium.
Correct. Yeah. So it's all about finding out what the balance is for an individual.
Yeah.
But I'm very pro on having high level excesses, because we want to reduce the premiums while you're not using it. But we just need to make sure that you're actually in a comfortable position to manage the $1,000, $2,000 excess when that procedure pops up.
And have you noticed people cancelling their insurance, or hearing that in the industry with just how tricky it's been out there financially?
Look, there's a lot of hurt out there at the moment, and we're exposed to some of that. But actually, during these tough times, people will actually put more value in their insurance. So what the better strategy is to work with your advisor to see if there are ways of potentially suspending parts of the policy, go on premium holidays, and actually trying to find workarounds so you can still retain the policy. Maybe it's just a matter of going, actually our situation's changed and we don't need the same levels of cover. Can we look to review it and adjust that? And that's the way that we manage premiums, so we can retain it and hold on to it for the future. Because the risk is, particularly if you're in your 40s or 50s and you go to cancel it, and then the economic times get better for you and you're back in secure jobs and steady income, and you go, let's take the policy out again. Well, you might have had a whole lot of health conditions that have popped up since you originally took out that policy that then limits your ability to take the policy out again in the future. So you need to be very mindful when you are making big decisions like cancelling a policy, because they're permanent. So alterations are certainly a better approach. Yeah.
So let's say I take out a policy and I'm 20, right, and then all of a sudden 28 I have a bit of a back issue, but I cancel my insurance. Probably by the time I'm at 32, when I go, right, I can afford to do it again, I'm going to be excluded for things around my back.
Correct.
Because I then have to disclose that I've had that.
That's right. And as a back example, that's the number one claimant for income protection policies. So you do need to be cautious of, as I say, those cancellations. But equally, another way is to look at a policy that might have been in place for a number of years, has it actually got exclusions on it or premium loadings that can now be reviewed based on your health profile improving? Like, they're not a permanent fixture. There are ways that we can review it. Might even be you need to change provider to have it reconsidered, which is sort of, once again, plan B in that space. But there's always different angles that can be played, and just getting some good advice around it is a really smart option.
This is such a deep space to try and figure out yourself, right?
Yeah, look, if it's not the language that you're used to speaking in, you can see how people get lost, and that's why we try and take our time on our process. I remember when I first started in the industry, it was we meet once, we gather some information, we give you the recommendations, and here's the applications. I mean, it's oversimplifying it a little, but certainly now I say to people, look, if this takes 2 meetings or if it takes 10 meetings, it doesn't matter. I've got all the time. We just need to make sure that you're comfortable with what goes in place. Because ultimately, the advisor's not the one that's paying the premiums, but they're also not the beneficiary of that policy. So we need to make sure that everybody's comfortable with the plan that's going in place.
What word of warning would you have for those people who think, right, I'm not going to pay my insurance and I'm going to put that money aside myself, and is it really worth it? It's all a bit too expensive now.
Look, I think it's a really good plan if you can keep putting that money aside and you don't have any health issues and you're 30, 40 years down the track and your little pot's no longer a little pot, it's a big pot of money, and that sort of serves you better for retirement. But it's more of the what if factor, and that's why I say run a pragmatic approach to what levels go in place to try and manage those premiums, and just be a bit sensible about what you're doing from an insurance standpoint, because not everybody's got the money to be able to financially support themselves for the rest of their life if they're out of work tomorrow. And they don't necessarily have the family support to make that happen either. So who's going to look after you? What's your life going to look like if you don't have a plan B in place?
I can see why people get there, because they're looking for a way to cut some costs out of their life, or they learn, I heard that insurance companies just take that money and they invest it themselves and that's what they do. But like, what happens if you do die or get cancer or something like that in that first 2 years, or even probably like the first 10? You've got to run some math on, okay.
It just doesn't work.
Yeah, like I was going to say, how many people do you actually see come up with that strategy and go, you know what, and then come back to you and go, Johnny, guess what? I did cancel that and beautiful. I just got a cancer diagnosis, but fuck you, mate. I've got 300 grand stacked aside. Like, I'd imagine most people would be like, I'm going to build a deck, I'm going to do X, Y, Z, and wouldn't actually leave it there.
Yeah, look, I think for most people, they don't have the discipline of actually putting that money into an investment and then seeing it through for it to become tangible. So everything can balance. And if your approach is to self-insure some of it, great. You know, don't take out something you don't need. But think about what the downside risk is. Can you put a smaller amount of cover in place and have it only there for 10 years while you're still building that investment account? And in 10 years' time, let's reassess it. If you don't need it, let's cancel it. Like, let's be pragmatic about it.
No, so what you're basically saying is, like, you don't have to go the full hog, and there's different options where, you know, you might take one policy compared to 3, etc., and then just keep adjusting as you go. Yeah,
and it might be that you run a staged approach to it. So, you know, I appreciate, particularly with clients moving into their first home, like, budgets are put under pressure, and then you've got all your moving costs and setup costs. So putting the insurance piece into the budget can be very challenging for people. I get that. But look at where the support would potentially be for you. Like, we do still have the public system, so that is your fallback in that particular space. But if you're out of work, if you've been faced with a major health condition, financially, how are you going to manage that? Perhaps short term, let's just get some lower levels of life cover in place. Let's put in a bit of trauma cover so we at least know you've got something. And if that day does come along, at least you're going to have some financial breathing space before you're forced to sell the property, before you're selling off your car and all the toys that you might have in the background.
Yeah.
Because if you're forced into selling a property, you're not going to get a premium for it. Murphy's Law will say it's a bad market and it's a bad time to sell the property. Factor in real estate fees, and all of a sudden, if you'd only recently bought that house, you're not even getting your deposit money back. You've just de-risked it because you paid the bank off, but you actually haven't had any real capital that's going to support you at that point in time.
And what about with the introduction of KiwiSaver and KiwiSaver getting a bit larger? Are that some of the conversations you're having with older clients or clients that have gone through that journey where they go, you know what, Johnny, we don't actually need some of these policies anymore because we've got a pot of 600 G's sitting there in KiwiSaver or an investment fund and things like that?
Yeah, absolutely. And great that we love seeing that, where we can minimise insurance and be practical about it. That's what we're very pro on. Where we need to be a bit mindful is where they're saying that they've got a lot of wealth tied up and they're in assets that aren't overly liquid.
Yeah.
So,
property.
Well, property, yeah. But even investments to the most part, like there can be some pretty serious break costs, or you might not get a very good return if you're having to pull that money out in a short time frame. It might still be that it's quite practical and sensible to have a level of insurance in place so you know that you've always got, your plan B there while you're actually liquidating some of those assets on a timeline that realises the most value out of them.
Yeah, it's interesting. I'd imagine that probably some people, once they get to that stage, they would see the cost of some of these policies and go, hey, you know what, it's actually not that bad. I'm just going to continue to pay it. And then they sort of end up accumulating more wealth if it's triggered.
Yeah, and like I've got a client who's exceptionally wealthy. They've got a huge amount of assets that sit in the background, but he knows his household running expenses are massive, and it's going to take a long time for his wife and children to get access to his assets by the time they've gone through the courts and managed through the wills and trusts and all the complications involved in that. So he still keeps $1 million life insurance policy, and it's a nominal cost for him to know that his wife's going to have immediate access to funds while she works through that process to get the assets transferred to her.
Yeah. Different level of thinking, isn't it?
Different level of thinking, and it's all proportionate to people's positions, though. And that's something you've got to remind yourself of as an advisor is everybody's different, everybody's needs are different. So there's no one-size-fits-all approach.
And that's the key for people to actually engage with this space and realise it doesn't need to be scary, or it doesn't need to be slimy or salesy or whatever they preconceived ideas be. It's basically, I need help understanding my situation from somebody who has the expertise.
Yeah, like we're not going to ever sit there and say that you're wrong, but we might guide you on saying, hey, look, I get the logic of trying to manage premium and removing these particular benefits, but we still need to keep this in as a base plan.
What would you say to those people who are listening and are thinking about maybe getting into the insurance industry for a career?
Yeah, look,
you're probably a careers advisor in this space now after a decade.
Yeah. Well, maybe give me a call because we're always looking for good staff members. So, but look, it's a great industry to join. It's very rewarding. Yeah, so look, I would sort of welcome people into the industry. We welcome advisors. I feel like there aren't enough of us to go around. We need to be building out our space and spreading the word wider and further. But it's a rewarding industry that you can build a business off the back of helping people. So it's a way that everybody can get what they need.
Before we go, mate, any gnarly stories or any favourite stories from your decade in the game?
Well, a story that I touched on earlier is my friend who had this stroke. It was a tricky situation. He'd actually been to a chiropractor and had a neck adjustment, and he had a very rare outcome from that adjustment, which was a stroke. So he literally drove there, was taken to the ambulance and a hospital afterwards. But this particular guy was sitting on some applications that we have been following up for about 18 months, and he refers to it as the claim that cost him $1 million because that was an increase that we were looking to make to a part of his policy. Fortunately, he already had some very good cover in place, so he was well supported. But while the conversation's live, action it, don't let it drag on too long is the key takeaway from that. Just trying to think of some other good stories.
There's always the ones in the media we see, right, where it's like someone cancels the policy and 3 days later. I'd imagine that probably happens more than people realise, but it's such a good story. But statistically, it's such a good story to sell attention, but statistically, that probably happens quite often.
Yeah, look, certainly we encourage our clients who have been long-standing clients of ours, or we've got very good personal relationships, or don't for that matter. But if they are looking to cancel their policies outright, we do encourage them to go and get a general health checkup with their GP, go and run a set of bloods. Look, the policy's going to stay in place for maybe another month. You might have to manage another month's worth of premium, but it was worth it in case something came from that consult. and there was going to actually be a claimable event, or there was starting to be markers that might lead to there being a claimable event, within a short timeline.
Oh, you've just scared the shit out of me going to the chiropractor the next time, mate.
Yeah.
We didn't even really touch on the business side of things. So in terms of some of that cover, I'm assuming you still do like quite a bit in that space for business owners?
Yeah, so the conversation just changes from it being around individuals and families to it being individuals and their business partners.
Yeah.
And what we see in the business space is, quite often a couple of mates have got together, they've built a business out of their back bedroom, and all of a sudden it's turned into something that is worth quite a lot of money, but they don't personally have the available funds to manage a situation where their business partner passes away and they're now in business with the wife or the husband, or the wife or husband's now asking for their shares to be bought out at some sort of premium rate.
Yeah.
And so we try to manage that through insurance with benefits like life insurance and total and permanent disability cover. And then there's also other ways that we can start to focus on business type clients where they might be key stakeholders in the business and vital to the operation. What happens if they're taken out of work? How do we make sure that business is going to keep running, and how are we going to make sure it's financially supported? And there's effectively income protection type policies for businesses that allow for locums to go in, work in the business, make sure it keeps operating, make sure everybody else stays employed and everything keeps ticking over in the similar sort of capacity, while one of those stakeholders is out of work focusing on their recovery program and until they get back.
Definitely something that people that are in business with somebody else should probably be thinking about, right? Because
Absolutely.
all of a sudden they could find themselves in a position where they're now buying back the shares in the business that they helped build, or borrowing against their property to clear out the spouse of the business partner. Sure. And going, holy shit, how did all this happen all of a sudden?
And it's not always your intention to go into business with your business partner's spouse, right? Or their children, and that can quite often become very complicated. And then there's differing opinions, and it just means that the business value might actually rapidly decrease over time. So can a plan be created so if certain events are triggered, known outcomes can be achieved, and then everybody's on the same program? Families are getting taken care of, business partners are being cared for, and it's just a known quantity.
Nice, mate. Well, who would have thought that insurance isn't as boring as accounting? And we could rip through it out that quickly.
Yeah, awesome, mate. Thanks for having me in. Really appreciate it.
So people want to find you, Johny. Where do they need to go if they need to get in touch?
Best to look up our website, which is Insurance Market Collective. Reach out to me directly on Instagram is probably a good approach. Just Johny Winstone, all one word. Yeah. Hopefully you can tag me at the end of this pod, mate.
Yeah, no worries.
But
even LinkedIn.
LinkedIn is always a good approach too.
An email address?
Just j.winstone@insurance-market.co.nz.
Cool. I'll chuck some details into the show notes if people do need help in this space. Thanks again, mate, and I'm sure we'll have to kick around some of these other topics because it's a very big space, and to be, to try and summarize all the work you've done in the last decade in 1 year doesn't do it justice, but I'm sure that would have got people thinking a little bit more about some of the things that they've probably been putting off.
Yeah, excellent, mate. Well, really appreciate you having me in, and it's great to actually be sitting in the chair and be part of the community, mate.
Yeah, you've probably listened to how many episodes now? Too many? You're probably sick of my voice.
Yeah, probably too many, mate, but they're always valuable, so I appreciate it.
Brilliant.